I think we are live, Pak Ji.
Are we live?
Yes, we are.
Hi, everyone.
Good evening.
Good evening.
Hi, good evening.
This is the first time we are doing this. So if, for example, you are hearing us, just give us a emoji, say yes, like that, and we know that you are there. Are you guys there? Give me a... hi. Hi, Roxanne. How are you? Yes. Hi, Mishan. Hi, Kelvin.
Hi, Ryan, Mishan.
Hi, so good to see all of you. Hi, Clarence. Hi, Rebecca. Nice. Okay, some of you are on Facebook and some of you are on YouTube, I think. Hi, Sarah. Sarah is the leader here. So you all better say hi to Sarah because she's the leader. Hi, Tom. Hi, Zach. Hi, Albert. I feel like Jimmy Kimmel now, I feel like Jimmy Kimmel with two guests. It's just that I'm not gonna do a opening monologue. Yeah. Anyways, I hope you guys had a good dinner. It's 8:30. It's the second day of the CMCO. Yeah, I hope all of you are either back to work or getting back to work very, very soon. All right. Today I saw that the traffic is back to jam right outside my house. Jam all the way. And man, I'm really not looking forward to the jam anymore. After 1.5 months of peace, and finally we are back to all the same old jam again. Yeah. Anyways, tonight's gonna have a very, very fun night. We're gonna talk about something very, very interesting. I think that's very relevant in what we are facing right now in the market, in our career, in economy, in our lives. All right, and I have two very, very important guests, two very good friends of mine, Raymond and CK. Later on, I will introduce who they are, but they are good friends of mine. I've known them for a number of years and really solid people. Okay, so let me just give you a brief introduction of who they are. First and foremost, I want to introduce to you Mr. Kian. He is the Group Executive Director of Irika Corporation, Berhad, involved in construction, hotels, development, infrastructure, and if I'm not mistaken, yeah, CK, also going to transportation, yeah, very, very soon, hopefully, yeah,
Yeah.
Okay. Yeah, so yeah, that's CK. The other one is Raymond Chooi. Raymond Chooi is the Director of Equity Capital Markets of Maybank Investment Bank. Yeah, a very wise man. If you want to know how to save money, and invest properly, this is the man that you must look for. That is why we got those two very powerful people here today. All right. Just to very quickly tell you, I think probably about a few weeks ago, a month ago, yeah. Actually, this was something that Raymond did probably about a month ago for CLC Penang Seed Initiative, and man, it was so good. All right, and that's why we decided, yeah, we're gonna bring this to Collective Central. Okay, CLC Penang got it first. Now it's our turn. All right, so I don't want to talk anymore. All right, I'm gonna pass this time to both of them, and I hope every one of us here will really be learn a lot of things tonight. Okay. Yeah. All right. I'll pass the time to Raymond and CK.
Thank you so much, Pak Ji. Welcome to Tuesday Night Live. So, wow, this is the first time I'm doing this actually. So, pretty interesting to be live here speaking to you guys. So Raymond and I are just gonna, have this conversation, for hopefully the next hour or so. We welcome any questions. So if you can post those questions on the live on the chat, either through your Facebook or YouTube, we'll try to get to it. We may or may not be able to actually get to everyone's question, but we'll try our best. Yeah. So we are here today to talk about sense and sensibility, right? As you guys probably know, right? Sense, S-E-N-S-E, right? Sense and Sensibility is a very famous novel by Jane Austen. But we are now talking about sense, C-N-T-S, right? Because in this unprecedented time, I'm sure at some point in time, this period of time that we're living in is going to be immortalized in a novel of sorts as well, right? So we are living in interesting times, right? COVID-19 all of us have been stuck at home pretty much for the last 45 days or so. Some of us have got some reprieve and we're out and about now. But I think the reality is that in terms of the economy and where we are today, we are definitely not out of the woods yet, right? We may be out there doing things, trying to actually normalize, our daily lives. But where we are in terms of the economy is definitely far from having recovered. Okay, we were just chatting actually prior to this about about the economic crisis. Where we are today. From at least from my perspective, right? And I'll get Raymond to actually share a bit later as well. A lot of experts have actually said that this crisis is actually much deeper than the previous crisis. Right. So the previous crisis, the global financial crisis, is basically back in end of 2007, full blown in 2008 and 2009. Okay. And that financial crisis, the epicenter of that financial crisis, right, actually started in the US, right, whereby the so-called subprime lending crisis happened. The economy was essentially over leveraged. Right, and asset prices, house prices started dropping, and that basically caused a lot of the financial system in the US to actually start collapsing. But if you think about it, right, by and large, what had happened then in 2008, 2009, right, was first started in US, and it was actually contained pretty much in the US, right, and things didn't really ripple out into this part of the world in Malaysia. Up till sometime in 2009, right? So it took quite a while before we actually came to where we are today. You would know today that if you guys have been reading the news, right, our Bank Negara Malaysia, our central bank, has actually reduced the OPR, overnight policy rate, to 2% by 50 basis points, right? By 50 basis points, and that 2% was last seen back in February 2010. Okay, and back then, actually, the Bank Negara reduced those rates in sometime in just let me see, in January 2009, right? Basically, in response to the global financial crisis. Now, the global financial crisis proper actually started only sometime in March 2008, right? So the real response to our economy in Malaysia here, right? The Bank Negara actually didn't really we didn't feel much of the effect, right? Up until in January 2009. Yeah. So whereas for this here now, the difference is that the COVID-19 pandemic crisis that we are feeling, right, is really hitting us right in the heart of our economy, right? People like you and me, right, who either run business or we are salary earners, wage earners, are basically having issues because either our companies are actually cutting salaries or they're being deferred. Businesses out there are actually not open or can't open, right, because of the COVID crisis. So it's actually hitting us right in the middle of the economy where we are supposed to be most productive. Yeah. So with that in mind, obviously our central bank has actually reacted fairly quickly by cutting the rates down to 2% now in OPR. Right. So you can see that the difference is that the previous global financial crisis took us a while before we actually felt the effect. But this crisis, we almost all felt it all immediately, right? And the issue is that I think it will be here for quite a long time to stay. Yeah. Maybe I'm just going to ask Raymond. Raymond, maybe you share your thoughts on where we are at the moment in terms of the economy.
Sure, CK. Thanks. Yeah, like we mentioned, this is not going to be an easy period, right? I think if we compare to the global financial crisis, for Malaysia, recall that after the global financial crisis, we were looking at a economy impact of minus like 1.5%, if I remember correctly. But this time around, at such an early stage, we're already getting forecast estimates where the economy is going to worsen beyond 2 to 3%, right, at this point. And if MCO is going to be prolonged, that's going to be worse. So, and then the other number to look at is, after the global financial crisis, you've got US printing like $9 trillion in total. That is for the years to come. But for this year, right after the COVID pandemic has spread to the country, right, and affecting markets, you see all central banks coming in at the same time to save the economy, and immediately US was pledging almost $6 trillion in total to support the economy. And subsequently, as the last measure, they said that they will go all out to support whatever the market needs to ensure a smooth working of the markets. So, and then European Central Bank also came up with like 750 billion of package. So that tells you the degree of severity of this crisis. But the good thing is central banks are all, in a way, attempting their best to pump, or rather to ensure the markets are still working and working well with sufficient liquidity. So that is the saving grace for now. But that's only in terms of markets, right? In terms of the real economy, the actual impact of that will not be felt until the weeks to come and the months to come, when everything goes back, when everything opens up again. Then we'll see what is the impact towards businesses, how many of them are actually going to be closing down, and how much is the unemployment rate as a result of that. So as it is, we're looking, or even for the US, it's a scary number, and then you look at all the news articles that's coming out, you can see people actually queuing for food subsidy and all. It just goes to show actually like how bad it is actually in terms of the impact to the people around us. Right?
Yeah, I think Raymond is frozen a bit.
Can you?
Oh, yeah, you're back. Yeah, okay. Yeah, I mean, Raymond, so is it fair to say, right, that, if you think about it, the crisis actually, the pandemic, started out here in Asia, obviously in China, right? Then it traveled to Asia before it actually made it to the US, right? But it seems like that the economy started to collapse faster in the US, right? We are seeing unemployment rate rising to a great level in the US. Whereas here in Malaysia, at least, let's just talk about Malaysia, right? We seem to be fairly sheltered. At least things doesn't seem to have hit us just yet. Is there a reason behind that, you think?
Well, I guess it all depends on how the businesses are prepared for that. And I think for us, we have been in the lockdown period for a bit of longer time, and I think maybe employers here haven't got to a situation of assessing, getting the opportunity to assess their business and impact yet. And I think we are also employers are trying their very best to keep their employees in place. I think unlike the US, we don't have the benefit of unemployment subsidies, right?
That's right. Yeah.
Yeah.
Yeah. I think that is really the one of the key reasons why we are not seeing that much unemployment just yet. But I think the reality is that at least from where I'm sitting, in terms of the tourism industry, we have got 2 hotels in our portfolio. We're also in construction and property development. Our hotel portfolio of hospitality is definitely one of the hardest hit. The hotels haven't been open for the last 1.5 months. And it doesn't look like tourism is going to recover anytime soon. It is true. I think most of the employers out there are still trying to protect as much jobs as possible. But I think in reality, for us, for people out there, I think we just have to really be prepared, for what's to happen, in the coming months and weeks. And actually, that is really what we want to try to address here today in our talk today, sense and sensibility. We are in fairly unprecedented times, like what Raymond and I have shared earlier. And if this economic crisis is really gonna stay here for the next at least until end 2020 or maybe even beyond, right? What is it that we have to really look into in terms of our own financial planning, right? Financial prudence is something that's actually really important. So maybe Raymond, maybe you can start off by sharing, what are your thoughts around financial prudence and spending habits in this time of crisis?
Sorry, if you can just give me a minute. I think let me just shift to a better location in my house for better connection, because the connection seems to be breaking up.
Okay.
Just give me a minute, yeah.
Sure. Okay, so whilst we wait for Raymond to come back, I'm just going to share a bit as well. And unfortunately for me, even for me personally, I haven't been spared by what's happening around us, right? Like I said earlier, we are in hospitality. We've got 2 hotels in our portfolio. The hotels have been generating zero revenue over the last 1.5 months. We are also in construction. Our construction sites are not allowed to operate up until this week, right? Where we're slowly going back to full steam. And the other side of our business is actually property development. Properties by and large depends a lot on the confidence of the people in the economy. So we are actually seeing sales in fairly difficult situation. Yeah. I've just got a message from Pastor Kevin out here. How's fatherhood? Fatherhood has been great. So this is really a bit of a blessing in disguise for me, right? Being locked down and being able to actually spend time at home. But I think the challenge is always, how do you actually draw a boundary between working versus spending time with family, and that line seems to be blurring. Every time I wake up, I'll be here at the table working on Zoom calls and so forth. Yeah, it's been great. We've got Raymond back here.
Hey, hi. Sorry about that.
No problem.
So where were we again?
Yeah, so Raymond, I was just saying that obviously, like we said, this is fairly unprecedented times where we are, right? And this economic crisis that we're in will probably last at least until the end of 2020 and probably even beyond, right? Then the first thing obviously that comes to mind to a lot of people is financial prudence, right? How do I really make sure that I plan my finances well, right? So that I can really live through this time, basically stretch my money essentially through this time. What are your thoughts around that?
Well, for me personally, I think one thing that sticks to my mind always is this concept about self-sufficiency, right? So really, just reevaluating all the expenses that we incur for ourselves, for our household, and all. And just make sure that we just need to review and ensure what is the amount that we need to ensure the essentials are covered, right? I mean, for me, I always look at expenses in 2 broad categories. One is essentials. So your day-to-day, your groceries, your utility bills, those are really your essentials. And then some of it, to some extent, whatever that is needed to support your work. But otherwise, other than that, is really can be categorized as variables. So I think during this tough period, we can only ensure that we have sufficient to cover the essentials, spending on the essentials. As for the variables, whether is it gym membership and all, maybe we got to look into cutting those just to ensure that we be able to survive for the months to come. Because like you said, it's not a matter of weeks or even 2-3 months. This is going to go beyond that. I think from market perspective, typically you need to see at least about 9 to 18 months or 9 to 12 months from the lows of the market to where it was before the crisis. Now, are we at the lows? We really don't know. everybody is trying to call for a low, right? Markets has been rebounding, wondering why is it still performing that well when economy is supposed to be worse off. But really, there are so many players in the market. Everyone has got different views. Now, if you look at valuation methods and all, yes, there's supposed to be more downside, but what we saw this time that was very different from the previous crisis was the central banks coming in to save the economy, or rather save the market for now. So that panic has been erased somewhat. Markets are calmer right now. So for now, it looks okay, but the real impact to the economy won't be known until for the months to come. So I think in terms of our own spending, we just need to be careful about that, and then make sure that we are able to save up whatever that we can for the months to come.
Yeah.
I don't know, like for yourself, what do you see in terms? What's the biggest change in your spending pattern?
Well, during this last 40 over days in MCO, right? I think it's a great way of actually to start saving. I've always tell people that, look, why go to the gym? You can run outside; it's free, right? So, but anyway, yeah, you're right. This time is going to be tougher than where it is before. Bring ourselves back to 2008, right? During the global financial crisis, Seein, my wife, is actually working for JP Morgan, an US investment bank, right? She was actually laid off in October 2008, right? So after the collapse of Lehman Brothers, right? And in December 2008, we were supposed to get married, right? So you can imagine that, we were both thinking that we are going into this holy matrimony, right, with double income, right? Suddenly, there's actually only one income left, right? Well, it was a blessing in disguise as well. Obviously, we had a great first year in marriage. Seein was doing a lot of things that she had wanted to do. When she was actually busy working in the investment banking. But I think all this, we were obviously quite fortunate, to have some savings there to be able for us to actually spend the next 1 year for Seein to actually explore what she wanted to do, right? And then at the end, sometime in 2009, she joined Maybank Investment Bank and was actually Raymond's colleague. So that actually taught us quite a bit. No matter where you are in your career, you are very unlikely to be indispensable to your company, right? The reality is that when the economy really hits, right, and businesses are having it difficult to actually make ends meet, right? They would cut from the top to the bottom. And I think this in this crisis that we have, like I said earlier, it's actually impacting people on the streets first, not the banking sector, and then not your not your higher paying sector, but actually all the people who exports, people who actually do services, the people who works in hotel, right, will be without jobs. I think in the next months to come. So that really taught us financial planning is actually really important. Being able to build a savings or safety nets, right? Over a period of time. Yeah. So yeah.
I think for me, last time during global financial crisis, I was still single back then, so it was easier for me. But you just don't take things for granted. I mean, back then I was fortunate enough to remain employed. But having said that, in today's economy, you can't assume that to continue for the months or years to come. So we just need to be flexible in the front, and at the same time take a prudent stance in terms of our financial matters. So wherever we can, we will just have to save up. For investments, you just have to make the more of a prudent stand on that. Yeah.
Yeah. So when it comes to savings, right? What is your principle behind it, Raymond? I mean, is there like a percentage of what you earn, when you get on a monthly basis that you actually set aside for savings?
Well, yes, there's targeted savings. Of course, we work on a budget, right? So, as I mentioned earlier, if you do categorize spending between essentials and variables, you get a sense of how much roughly you actually will be able to save at the end of that. Right. There are also school of thoughts where you should put aside an X amount upfront. So you can do that, but provided you've already established what you really need in terms of essentials, and of course then whatever extras will be your savings. I guess we need to make a balance whether how much we are to save and as well as the quality of life that we are getting.
Yeah.
But the bottom line is there shouldn't be any months where there will be deficits. Because if there is deficit, then we should really review whether is it because income is of concern. Then we need to relook. Is there any other options to raise our income, or is it the way that we spend? Right?
Yeah. Do you think there is a optimal target as to how many months of reserve should one keep? Especially like looking at this kind of financial crisis. Do you have any number in mind, or at least what do you yourself actually practice?
I think there was a survey done recently, right, to see how much savings are there for that people have during this crisis, and I think less like over 90% doesn't have enough more than 6 months. So I think ideally we have to have at least 6 months. Anything lesser than that, really, I think we are just kind of like living on the edge. Because think about it, if let's just say one gets unemployed during this season, it will definitely take more than 6 months to find a job.
That's right.
In a normal case.
Yeah.
So I guess a lot of people also ask, what if there isn't enough right now? But I guess it's never too late to start somewhere. Maybe it's less than 6 months for now, but at least now we still have a situation, a window opportunity to do so if we are still employed, right? So just take that opportunity to accumulate as much or save as much as possible for the rainy days.
Yeah. I think now especially where we are today, it's a good time for every one of us to relook at our own spending habits, right? We review our spending habits. Like what Raymond said, you can quite easily actually classify into essentials and non-essentials. Your bubble tea are definitely non-essentials. So those are the things that you can hopefully cut out and try to build up on your savings, right? The 6 months target is definitely good. But if you can actually try to aim to a year of savings, by basically you stretch your savings also by cutting down on your non-essentials, right? So that way you can actually look at where how long can you last without a job in certain circumstances. Yeah. I think a lot of people will also be thinking, right, Raymond, at this point in time, that now obviously I've got a certain amount of savings. They may or may not be salary cuts, right? There will also be a lot of people who are in debt at the moment, right? Not necessarily negative cash flow, right? But I've got a lot of debts out there. The good thing is that obviously, our Bank Negara Malaysia, central bank, right, has actually implemented this 6 months moratorium, right? But when it comes back, it is not free money, right? This 6 months is only a moratorium. What it means is that you still have to pay back your amount owing. But I think the reality is that it's also a good time for us to actually relook at our borrowings as well, right? Whether it is personal borrowings, your housing loans, your car loans, so-called your hire purchase, even your credit card debt. This is sometime a good time for it to actually look at it. Yeah. You have any thoughts around that, Raymond?
Yeah, I think whatever the season in our life, I think over gearing or getting over borrowing is always a big cause for concern, right? I know there are situations where it's attractive to borrow and to leverage and to make investments. I guess at the end of the day, it's all about the balance. Economic situations can change quite quickly, and once we are getting tied down with the debt, it's not a short term, right? It's not like a revolving credit. It's a term loan that stretches for many years ahead of our lives. I think I recall last time during the peak of the property market. I mean, banks were so generous. They were actually willing to lend to borrowers with the guarantee of their next generation, right? So
two-generation lending.
Yeah, it's attractive, right? It makes everything affordable, but to think about it, really, do we want to burden the next generation if anything goes wrong? Yes, we can be all optimistic about our lives and say, we will have there shouldn't be anything disruptive in our life, but we really don't know all these things. So I guess we just have to be prudent on that front. But having said that, there are opportunities where we can actually leverage up, especially like these days. If the borrowing costs do remain this low for a long period of time, and I think it will be. Some people may want to leverage up to buy properties. Why not, right? After all, then in terms of your payment, a smaller percentage of it goes to interest payment and goes more towards your principal. So that's fine, but you just have to make sure that at the end, after paying down all these obligations, our cash flow on a month-to-month basis is sufficient for us to be comfortable with to carry on, right? We don't want a situation where it impacts our mental health. We get stressed up because we are worried that we won't be able to meet all these payment obligations. So although we can borrow easily, but we also need to make sure that how are we going to use that money effectively or wisely. Even for purposes of borrowing for investments or businesses, you just need to be careful whether those business that we're going into is really that viable or not. Carry out proper due diligence, business plans as well, to make sure that you won't be caught by surprises.
So there are also people who have come to ask me, about this moratorium, all right? Because you can either opt in or opt out, right? And obviously, I think most people would actually opt into this moratorium, which means that you don't have to pay your loan installments for this next 6 months. Even though you are still gainfully employed at this moment. But I think the one thing that you really have to bear in mind is that, like I say, it's not a debt holiday, right? You still have to pay these debts at some point in time. If I were you, and if I'm still gainfully employed and my salaries hasn't been cut, right, I would set aside this money, right? Do not even try to invest it or actually put it into something that is, to buy your next handbag or next pair of shoes, right? Because that is really not the wise way to do it. In fact, that a few days ago, there's been slight confusion, right, when it comes to hire purchase purchase agreements, right? That means car loans, right? Whether there is going to be interest going to be charged during this 6-month moratorium. Currently, I think the Bank Negara said that there is no interest holiday during this period. What it means is that when your hire purchase, when the 6-month moratorium period ends, right, you have a choice to either pay the entire amount, the 6 months that you haven't paid in October, right? Sometime in October, yeah. Or you actually pay a higher installment amount, right? So you can actually opt for that, right? So what it means is that you still have to pay for it. So what it means is that if you have got sufficient cash flow, you would either, even if you opt in, do set it aside, right? So that you can comfortably pay after the moratorium ends. Yeah. So I think that is actually really, really important. Okay. So now, then let's move on to a slightly different, I suppose, outlook, right? If I've got my savings sorted out, okay, my borrowings are all at a manageable level, right? And they're backed against a productive asset, let's say a house, who has got rental income to be able to pay off. And I've got surplus, right? Surely I would want to invest it, right? I think a lot of us want to be able to actually earn the extra income during this period and to invest, right? Raymond, you are in an investment bank. Do you have any thoughts as to what kind of investment that people should be looking at? Is it a stock market or is it any other products? Just as a so-called funny fact, right? During the MCO period, Rakuten Trade, right, which is this online trading platform, right? Their online accounts sign up, right, has actually gone up by 100% during the MCO fund, right? So everyone seems to be very excited about investing into equities, right? So what are your thoughts around this, Raymond?
I think any time of the season, for us to make money, I think one of the best chances is actually to buy things cheap, right? So how do we know then what we're buying is cheap? So that is one underlying, should I say, principle that we should carry in our minds, right? We always like to save, even when we buy our own, shirts or shoes. I think when there's sale, there's always that good feel that we have, right? When you walk into a sale, we know that when we buy something, it's 50% off, 70% off. We come up so much happier, right? We won't be happy if we know that we're actually overpaying something. Say you pay for a pair of shoes for 500 ringgit and then only to find actually you can get it online for 350, right? So the same thing applies. In today's market, we see prices falling and then rebounding, but is it cheap? So we need to ask ourselves that. To me, about investments is that every time we put money down, we need to know where it goes into. How is the money working for us? We need to understand that mechanics. If we don't know, then highly unlikely that we know whether what we are buying is cheap enough or not, or is it even fair value? We won't know, right? So it would be good if we, take the chance or take opportunity to actually learn about what we are buying or what we're investing into, whether those things make sense or not. I guess there are many people out there also who are asking the question like, I don't know, right? And I don't have much financial knowledge. So what do I do then? Well, I guess the next best thing is really to find a reliable reference, whether is it, a partner, friends, or even, a personal financial advisor, somebody who is savvy enough about the financial matters, especially with regards to investment products. I noticed that there are a lot of nowadays with the advent of technologies, there are a lot of platforms for you to invest, and people make claims of all sorts. I think most recently I saw one. I heard of this advertisement. It's called Olympia Trade, right? The advertisement line goes very simple. You put in the money now. I put in the entry and exit levels, and then within minutes, I get my 75% or 80% of my money returned back, just like that. Yeah. All you need to do is just register with Olympia Trade, and then there you go. You're gonna make 75, 80%. But they never tell you what's the risk, and they never tell what are the chances of these people actually making such an amount of money. 75%.
They tell you what they're investing into.
The moment for me personally, when I hear such advertisements, it just puts me off, because it's very deceiving. We all know there's no such, what they call Chinese, what they call Chooi, right? There's no such water fish that's so easily available out there. So I think for us, we just have to be very careful during this period of time. It's unimaginable during this tough period there are scams going around, right?
Yeah. And there's a question here on the screen here. Is it now a good time to invest in shares? I suppose Raymond actually shared earlier to say that yes, prices have definitely come down. I was just looking at the KLCI index today. Today we are roughly about 15% down from 1 year ago, right? Which I suppose makes it seem like it's actually cheap, right? But I think also at the same time, we need to realize that stocks obviously go up and down, right? It's tough to tell, whether there'll be so-called another shock, right? To the economy as well as to the share price. If you recall, when the MCO was actually first announced in Malaysia, right? Over the week of the MCO, I was looking at it as well. The KLCI actually dropped by something like 15.5%, right? Then it bounced back up, right? So it's very difficult to tell. And obviously, trying to find the bottom is always going to be difficult, like they say, right? The principle is easy, but trying to find the bottom is actually not easy. Like what Raymond has said earlier, the most important thing is that you really need to understand your investment objective, right? And are you in this because of the capital gains, or are you looking for yield, which means that recurring income type investments, right? And if you're in it for the capital gain, what is really your holding period, right? If you are trying to make a quick buck, and you're actually investing on borrowed money, then it becomes really fragile, right? So I think that is something that I think each and every one of us have a very different investment objective. Raymond, I mean, how important it is to really set up front to really understand what you are investing in, right? And also what is your investment objective?
Yeah, I mean, investment objective is essential because we are looking at a certain time frame, right? We would like a certain percentage of returns, but more importantly, what is the time frame that we are looking at? So it's not enough to understand that this product gives me X percent returns. Let's say 20% return, but what is the term what's the tenure that we're looking at? If it's 20% over 5 years, right? That essentially is under 4% on compounded basis. So it's nothing more than just like an FD, right? But if you're talking about 20% within a short period of time, 1 year and 2 years, that's a very aggressive return. So what is the difference between these two products, and what is the risk that we're looking at? So something as safe as an FD, right? We know that the money will stay there for the next 5 years. But if you're talking about 20% in a year's time and looking at a very risky investment now, what is the downside? Could it be a minus 20? Could we lose the capital entirely, or what? There are also funds going out there being offered to individuals, guaranteeing a certain amount of returns. It is backed by gold, some I think backed by some sort of plantations, different kind of assets, and then they guarantee you a certain percent of return, which makes it very attractive. 20-25% within a year guaranteed. So my question is, if Warren Buffett, right, he just appeared over the weekend on TV, and you find that he's struggling. Even he himself is struggling in this period of time to find it.
Yeah.
And if you look at him over the many decades of his business, he's only been generating 20% per annum returns, and that is already a very highly regarded investor. So logically, then, when somebody offers you a return of 25%, 30% guaranteed, are we looking at somebody that is more credible than Warren Buffett?
Yeah.
What is the risk that we're looking at here? Then? Yeah. So that's why we don't need to know the nitty gritty of finance, but at least the broad strokes of it, the macro details, sufficient enough for us to make some sort of a comparison, right?
Yeah.
There was another famous investor, Ray Dalio, right? He runs a hedge fund. So what is a hedge fund? Essentially, a hedge fund is a multi-asset strategy.
Yeah.
You can buy low, sell high. You can sell high and then buy it lower. You can buy currencies. You can buy indices. You can buy commodities, shares, bonds, whatever not. There's no limit to it. But even Ray Dalio at the beginning of this year, and at the start of the COVID pandemic, he has already suffered a minus 20% return on his funds. Right? These are all seasoned guys. So we just need to make some comparison and understand what is the underlying asset that our money is going into. Of course, if you talk about things like unit trusts, right? There is a full disclosure. There is prospectus. They tell you who's a fund manager, how much of it is invested in certain class of assets, in which country, how has it performed over the last 5 to 10 years. Then we know how these funds are performing, right? So at least those are the broad numbers that we should know. To me, it's insufficient to just rely on an agent or an advisor to say that this fund is good, so buy now. And then there you go, happily handing over your hard-earned money, and then 1 year, 2 years down the road, you find that actually you still haven't recovered your cost. But why is that so? So we just need to take the extra step to understand. We won't go into technical skills, but at least understand where did the money go into. What kind of assets? Were we looking at tech funds? Were we looking at property funds, real estate funds, or is it just a bond fund? And then what are the historical performance of the fund in the past? So that gives an idea, right? If a fund has been returning single digit 3 to 5% per annum every year, it really doesn't make it doesn't look that appealing as compared to fixed deposit.
That's right.
With all the market volatility.
Correct. So I think in short, we really need to understand what we are investing into, right? And having that regard to what you're investing into, understanding it, not necessarily from a technical perspective, and also having that horizon period where we are comfortable. When the investment is actually below its investment cost, right? Can you actually see it out? So that you can recover your capital. So I think that is fundamentally very important for investment. We've got a question here regarding the low interest rate we are having right now since 2010. Do you foresee appreciation of property prices in years ahead, like how it did significantly from 2009 to 2013? I guess I'm in property development. I'll answer this first, Raymond. Actually, property prices in Malaysia, right? Interestingly, the correlation with interest rate is not that strong, right? We've been in a period of low interest rate for a very long time, right? Since the global financial crisis. But I believe actually the uptick that you see in terms of the property prices, right, has more to do with the availability of credit, so-called availability of easy loans. Not so much cheap loans. Cheap is one, right? But also in terms of margin of financing, right? That the banks have been a bit less stringent, right, when it comes to assessing loan availability, and that has really fueled the property prices, between that period from 2009 to 2013. But also, I think at the same time, during this period, you do see real wealth being created, right? Which means the economy is actually doing fairly well. The Malaysian economy was growing something like in the region of 5%, 4-5%, over recovering from the global financial crisis, which means that real income is being created. But I think property prices started slowing down. Probably about 3-4 years ago, and what a lot of central banks actually realized, right? These years of easy money has to come to an end, right? Not just the Malaysian central bank, right, but also across globally, and they have started actually looking at our country, right? A lot of people are actually over leveraged. That means they got too much borrowings, right? And they start actually reducing the margin of financing, right, to a level that whereby if you are starting to own more than one home, right, it reduces to 80%, 70%. And if you're a foreigner who is actually on a work permit here, you can only borrow up to 50%, which means that you actually need to put up 50% of equity, right, before you can actually buy a house. So with that, prices have actually started to slow. So I don't think it's actually so much to do with the interest rate, right? It makes it slightly cheaper, but I think it is really prudent that the central bank is actually doing what it is today, right? To make sure that we call it responsible lending, right? To make sure that people actually don't get over leveraged. Property is a good investment asset class, right? It is a good store of value, right? But if you are investing into it so-called blindly, right, by one, either over leveraging or buying in a location that doesn't make sense, right, then it's a recipe for disaster, right? Property is actually probably one of the easiest to understand because you can actually see it. You know where the location is. You can actually drive around it to really understand, who actually live around the area. Is there a shopping mall coming next door? What is the traffic around the area? Be really comfortable with that, right, before you actually invest in a property. Yeah. And then I think there are enough comparables in the market. If you look at a building next door that's selling on it about 400 ringgit per square foot, and this particular developer is trying to sell one to you at 1,200 ringgit per square foot, I think then you really got to think, as to what is actually making the property so great. Yeah. To put it in perspective as well, I think in terms of properties, if you look across the property companies in Malaysia, right, they are actually not generating what I call super margin. I mean, they're making money, right? But as a property developer, costs all over are rising, right? Material costs have been rising over the years. So the prices, from my perspective at least, is actually justifiable. You may see some reduction in prices in terms of, because obviously oil price is at a low, right? Wages are probably starting to come down again. There's the side deflation, right? The property prices could come down, but you could also see the case whereby property prices in certain areas plunge, right? Because people have to fire sale, right? Because of the of where the economy is. People are out of job. They can't serve their installments and all, right? So there may be property that are being let go on a fire sale or bank auction type basis. So you will see a lot of disruption in terms of property prices, I think, right, in the next 1 year. So if you are in the market to buy a place that you want to live in, right, I would say, watch this space, look hard, and if you find a property that you really, really like, bargain hard with the developer, because developers want to sell you a property, right? So put on your most charming smile and and try to get a price as best as a price as possible. I would think it's a good time to buy. Yeah, and like Raymond said earlier, interest rates are going to come down, so it's an added bonus. Yeah, Raymond, any thoughts on properties? I know you're quite a savvy property investor as well.
No, well, I do look into those areas like you pointed out, right? So look at the surrounding neighborhoods, who are your neighbors, what's the potential there. But at the end, also comes down to a simple spreadsheet. For me, everything is all about spreadsheet, right? So just draw out how much you need to put in terms of the equity, right? What is the potential returns or rather rental that you can fetch? Now, this is where actually a lot of people overlook this. They assume every month of the year there will be a rental income. We forgot there's a potential vacancy period, right? We know we need to give, they need to give us as a landlord 1 month or 2 months notice, and then we need to find a new tenant. Now, in an economy like today, you won't be able to find. You will be very lucky if you can find a back-to-back replacement for your tenant. So, on average, over the holding period of your property, of our property investment, we need to buffer in that vacancy period. For me, I worked out before. If for every 2-year term, right, and I put in a buffer of 2 months. So that works out to be essentially, effectively, receiving rent for 11 months every year, right? That is even without deducting your commission for your real estate agent who will find you the tenant. Take that away, and then when you look into the potential, or what I call it is a ROE, return on equity amount, the amount that you put in it for investment, at the end of the day, you're looking at maybe somewhere around 12 to 13 to 14% at best, in terms of return of equity, right? That is after going through, let's just say, assume a minimum holding period of 5 years, going through the cycle, going through the trouble of finding tenants, handling the complaints, facing the stress and everything. So you're looking at low double-digit kind of returns. Now, one thing that many people forgot that is or may not be aware that's available out there is a product called real estate investment trust. Right? It's a REIT. So essentially, it's a portfolio of properties all held together under one trust, and it's listed on Bursa Malaysia. You can buy it like a normal like just a share.
Okay. Yeah.
So that is one alternative that we can look into instead of handling the property all by ourselves, finding the tenants, handling the maintenance. Because essentially, when you buy into a REIT, you've got a manager there, you've got a property manager looking after properties, and you don't have to worry about vacancy period because on a portfolio on a blended basis, that vacancy risk is very minimal. Of course, in what the REIT holds is essential. Essentially, for all properties, right, we're all looking about location. So when you have REITs which are holding very good located properties, there's really nothing to worry about, and it's all professionally managed, right? So that's one alternative to property investment. Now, during this period, I think for this year, for 2019, the market saw the lowest price appreciation since 2008. Even for KL, I think it was like -1%. Yeah. So if you're wondering why, right? People always say buy property, it always goes up, but you need to buy it in the right cycle. So yes, like you said, after the GFC, prices went up because at that time the interest rates were lower, there was easy money, and the economy was better as well. But 10 years, 12 years down the road, we actually saw people taking advantage of that. So much so that households now are all flooded with debt. Right? Household debt to GDP right now is over 60%. So that essentially means like over 60% of the income is all earmarked for debt repayment. How much more can a household plow into property investments from now on, unless your income goes up, right?
Yeah.
So we need to consider that when we buy the properties.
Yeah.
We cannot assume what has happened in the past 10 years to repeat from now on, because although yes, property prices have gone up, it's still a low interest rate environment, but the degree of appreciation may be different.
Yeah.
Having said that, because there's so much money printing going on right now, you've got 6-7 trillion after a 9 trillion printing. There's a lot of money out there. So the money being kept in the bank may lose its value over time. So we need to find a home for it, whether is it property, shares, or our own business, or even I would say education. For people, for me, at one point in time in my career life, I thought, okay, the best way to use my money is actually to invest in my own degree, my postgraduate degree. Yeah. So that's one other option. Because, we don't have to confine ourselves to hard assets, right? Investing in ourselves is also another form of investment. It's just that it cannot be quantified, but it definitely enhances our own knowledge and character.
Yeah.
So I guess whether property investment makes sense or not at this point in time, again, back to my first point, can we buy things cheap enough so that the returns are comparable or superior to what alternatives are there out there?
Yeah, that's right. Yeah. Good question from a viewer as well. Which industries do you see rebounding the fastest? I'll take this question quickly. I suppose you would see that this particular pandemic, right, has highlighted the healthcare, right, market as being something that is sometimes you can see that it's actually underinvested, right? Healthcare related counters, right, have continued to actually do well, right, during this period. And then the other sector, which is obviously doing well, right, is actually the new economy, right? If anything at all, this particular pandemic, right, has actually taught us how to actually work from home, to use technology as an enabler, right? And I think the digital revolution is just going to happen a lot quicker, I think business that are not digitalized, even for ourselves, right? We realize that some of our bank accounts, we don't even have an online banking account, right? So our finance staff, can't actually access those accounts for payment, right? So things like that have actually made a lot of businesses, brick and mortar business like ourselves, have to actually rethink, how we can actually improve our work processes, right? So I think the digital technology front, as well as the healthcare front, are probably the industries that are going to be leading the next revolution, right? For us as a brick and mortar business, I think each and every one of us have to rethink how we actually do business, and basically be relevant and be more resilient in this time of crisis. Yeah, Raymond, any thoughts?
Yeah, I agree with you completely. I think that together with the essentials, right? I think those will be the consumer staples. Those will be the essential items that will survive this crisis well. I think air travel, hotels. I think those will take some time to recover, even for our property to some extent. Discretionary spending, automotive as well. I think that will take some time for it to readjust back. Yeah.
Yeah, we've got another question here. I do realize that we are running out of time, but I think this is quite an interesting question. Any advice for business owners, especially SMEs, to continue staying relevant, not at risk of chaplap? I suppose chaplap, for those that don't understand, is going under or going bankrupt, especially those brick and mortar one that's badly affected, such as F&B, entertainment, and recreation. Yeah, I know, like what I've said earlier, just before this. We are a brick and mortar business. We build property and build construction. We build buildings, and we think that we are definitely here to stay, right? People still need houses to actually live in, right? But so it's not so much about, sometimes it's not so much about your business, right? But actually how you deliver your business or how you deliver your products, right? That you really got to rethink. To give you an example, if you're an F&B and you are completely reliant on customers that are walking through your doors, right? And you have never had an online presence, right? So during this period of lockdown, you would have a lot of struggle, right, in terms of serving your customers. People may still want your food, right? But if you haven't gone online, you are not sure how you can actually set one up with Grab delivery, for example. You will be missing a fair amount of business, I suppose, right? So I think it's tough to tell what is the next crisis that's coming ahead, right? And how to be prepared for it. But I think at the end of the day, business fundamentals are business fundamentals, right? You have to always look at your cash flow. Whatever business that you go into, right, you need to make sure that your cash flow will be able to sustain you through a prolonged period of recession, right? You got to look at your borrowings, right? Are you over leveraging your business, right, on assets that are not necessarily will be able to fetch the price that you think you can fetch, right? You got to look at your processes, like I say, right? Your digital processes. Are you sufficiently covered, right? When one segment of your customer is no longer exists, right? And you have to rely on another segment of your customer, right? So I think this period, unfortunately, it is going to be painful. I'm not going to deny it. But it's also a time whereby we really have to reflect on our own businesses. People will still have to eat, right? People will still go out, want to go out for a nice beer, a nice glass of wine, right? But rethink how you should be delivering that, and how you can actually withstand actually the next crisis. Yeah. Raymond, any thoughts on that?
Well, yeah, cash flows at the end of the day is essential, and I think we just need to sit down with the team and identify and understand. First of all, I think broadly need to understand what is the trend moving forward, right? After this, what is going to change the behavior of consumers or of our customers? We just need to err on the conservative side. I think for the next 1-2 years, I don't think we will be in the frame of mind to be back where we were pre-COVID. I think human behavior-wise, we will always be risk adverse. So I think in terms of for F&B, I can imagine that volume wise, it will take a long time before everybody gets comfortable dining out, sitting close to each other. So for starters, right now we've already seen, right, government regulations requiring 2 meters to be set apart from each other. So essentially, you're almost halving the seating area.
That's right.
So potentially you actually lose at least half your customer of what you used to have before, and that's assuming their behavior remain the same as before. But we know that everybody's going to be risk adverse. Everybody's not going to be comfortable sitting out there. So you're going to be looking at even less than half of that in the next 12 months potentially. So back to the cash flows, then are we comfortable on that assumption? If the cash flow remains negative and we don't have any sort of capital to fund that, then maybe we got to take a tough decision. But I guess that's the best decision given the current circumstance. So
Yeah.
I guess at the end of the day, it's a detailed study on the trend, on assumptions that we're making, and whether is it reflecting the trend moving forward.
I know our time is up, right? I'm gonna end also by saying that look, this is unprecedented time, for a lot of us out there as business owners and all. And obviously, we at Collective, I understand that, and hence why we are actually trying to do this to actually reach out to as many people as possible. Like what Raymond say, if you're a business owner and you are finding it difficult here, you gotta be confident in knowing that, right? Sometimes it's probably better for you to relook at your business and restart, relook and restart, right? And you have to be confident that actually, your failure in business today doesn't mean that you're going to continue to fail, right? There are a lot of successful entrepreneurs out there, right, who have failed multiple ventures before striking it. Yeah. So as believers, as Christians as well, right? We have to be very comfortable that our success in life is not equivalent to our success in business, right? To have the confident hope in Christ Himself, right? And I think this is a period whereby you really got to reflect and relook at your own businesses. So I think I'm just going to wrap this up now. I think what we have spoken today in terms of financial prudence, in terms of financial sensibility, relook at your own spending habits, build a portfolio of savings to enable you to actually withstand the crisis ahead. Invest wisely, prudently, understand where you're investing your money into. And if you're a business owner, do take this time to really study your business model, study your cash flows, and see how you can reinvent yourself. Yeah. Thank you once again for joining us. Thank you so much. Raymond and I are from a ministry called Compass within Collective. So we gather on a fortnightly basis, right? And now over Zoom, right? So you can actually join us wherever you are. You don't have to be here in KL or in Subang to actually join us. So you can follow us on Instagram. Our next gathering is actually happening this weekend. So we constantly talk about topics like these and how to make you more productive, more efficient in the workplace and the marketplace as well. So I hope that you can actually join us in one of these gatherings, and we'll promise that it will be a lot more interactive than us just speaking into the screen here today. Okay, Raymond, any famous last words before we bid goodnight?
Yeah, I guess it's not going to be an easy time for us, but as Christians, we all know that God is always looking out for us. It's tough times, but doesn't mean this is the end of it. It's a journey for all of us to learn whether it's an easy or harder way. But for me, I guess at the end of the day, if you look at it positively, in times like this is the only time that we can actually learn the most. In the toughest situations in our lives, only can we learn to improve ourselves. So, just take a chance, or take the time to understand ourselves better in terms of financial matters. A lot of times people think, it's a product, what kind of investment products are there which is attractive, which is good to give me the returns. But to me, ultimately, at the end of the day, it's all about ourselves. Even in investing like in shares, in any sort of in equity or financial instruments, at the end of the day, it's our character that determines whether we make it or not. Whether those instruments, investments are suitable for us, it all depends on our own character. We may think that sometimes we are just impatient, but investments do take time to be nurtured and to give us the kind of returns. So we just need to understand ourselves better during this time.
Yeah. Okay. Thank you so much again for joining us. Thank you, Raymond, for spending time with us here today.
Thank you.
Yeah. See you all soon. Bye-bye.
Bye.